Hey y'all, I talked about this a bunch of times, how to lock in profits for trades. Let's say you put on a trade, you see a steep down move, or a steep up move, and you notice that volatility is heightened. So when volatility is heightened, and because volatility does not last forever, you recognize that you want to make money when that volatility comes down, or you want to make money when the stock price goes down as well. You could put on a trade that stands to benefit for that, and trades that stand to benefit when the volatility goes down are sell to open trades. So you could put on something like this to make money when the stock price goes down as well, or if it sits still or stays away from this by the time expiration rolls around. And that's what this trade is. The 15,700 is more expensive than the 15,770. So because of that, this is a sell to open trade. These calls have been sold, and you can put this trade on, and you could potentially be wrong about which direction. So you have to be mindful of, you see POP, probability of profit, and you got to be mindful of the probability of profit, because that it's a theoretical value, but it's a theoretical value based on current options pricing and how the math is meant to be sufficient, at least sufficient at these specific volatility levels. So that's important. So with volatility changing, the probabilities could change as well. But 74 is, I don't want to say it's safe, but it's not a super risky trade. So once this trade, if this trade becomes profitable at some point, then to lock in profits, what you can do if you see it running hot and you're like, man, I don't want to take this trade off, my probability of profit is still fairly high, I don't want to necessarily take this trade off yet. I still think that don't think that this trade is going to reach this number by expiration, at least at this time, because it's not very volatile. This symbol is not very volatile. So because I don't want to take the trade off, I can just go to add a different trade. I can add this particular trade here, which is basically the exact opposite of this. It's still a sell to open trade that benefits when volatility goes down, but it's also a trade that, because when people don't realize, like, depending on which symbol you're in, the more volatility you have, the more of a two-sided market you may have, the easier it is, not the easier it is, the more, I don't even want to say straightforward, but it's more, it looks like more of a two-sided market, and that makes it able to, that makes you be able to, have more strikes that are available at your leisure, because this is the 80% probability of profit. This is a put. This one stands to benefit if the stock price goes up, but because it's sell to open, it'll benefit when volatility goes down, and it'll benefit if the stock price just stays the same. So if you feel like something is range bound, you can put on these types of trades just to make a couple dollars, every day. You can widen these strikes to, determine just how much money you're trying to make with each one, but be mindful of the one that's closer to the money. For a put, be mindful of the one that's under, the closer to where the stock price is trading at. So this one is closer to the stock price than this. So the 14,470 is closer than the 14,320. And so that means that this is a sell to open trade, because we have -1 right there. So we put that trade on when this one was profitable, and because we put that one on when this one was profitable, and then we actually had more trades on beyond this. So I had another one that I ended up taking profits on, because I basically had 3 call spreads, and I had 1 put spread, and then eventually I sold one of those call spreads because it was up quite a bit, because I basically rinse and repeat, just going back and forth between locking profits in by using another trade. So in other words, something is going to be profitable for sure. It's just a matter of which one at which time. Each one of them usually isn't profitable at the same time, but if you look right now, they are. So I put this one on today. This one is 76% probability of profit after I got rid of one of the calls, just to make this more even, more balanced trade. Not saying that I should be balanced. I just saw one of them was making so much money, and it made so much money quickly, that I just took the opposite side of the trade, thinking that it could potentially be profitable, and I ended up being right. And this is the only thing I wanted to show you. It's possible to have trades that are on opposite sides of the market. This one here, this 14,620 put was put on at the same time as this 14,480. So this here and this here, these are both bullish trades essentially, but they, like I said, these are sell to open, so you make money with each passing date. These are contracts, options contracts. So the closer they get to expiration, the more value they lose. It's an expiring coupon. Same with this. This is an expiring coupon, but it also is a bearish trade, so it stands to benefit when the stock price goes down. And this is the first one that I put on. The one that I had on before that had a higher profit loss open percentage. And these aren't huge trades. I just go back and forth all the time, and sometimes I make them wider, but because I have smaller ones on, and I don't really want anybody, y'all can see that the move is too late. If you try and put this trade on, you're a little bit too late to be able to have each one profitable. So look at this, -1. This one's at 11.3% profit. This one -1. This is at 4.6% profit. This says 5.9, but this particular strike here has a wide bid-ask spread, so you may get a little bit of slippage, but at the end of the day, this one is profitable too. Each trade is green. And then this one, of course, this is the one that I've had on for the longest, the 15.7. That one has a 41.8% probability. 41.8% open profit loss. So even though the percentages of each pair are not perfectly equal, each of these trades is green, and that's generally how I trade. I just essentially go back and forth trying to I put on these trades with certain probabilities of profit, and I go back and forth between allowing them to be profitable and to lock in profits. I just put on something else that has. So in other words, when this drops, if the stock drops, like I'm right about this bearish trade, I just put on this one to maybe benefit when it goes up some. And I put a high probability of profit so that I'm not caught off guard in case, because no one likes to necessarily try and catch a falling knife. You see your stock price going down. Nobody always wants to try and catch it. I just do it, and I do it with a high probability of profit. So in other words, the stock is going to really, really have to move. And that's why I trade small anyway, especially in this account. I trade small, and I trade quite frequently just to be sure that I am, I used to tell people that I was helping, that, I try and be like water. I try and flow and be, I'm always on the move, just because of the fact that, I know the market can turn at any time. I can be wrong. And, that's just how the market works. You know what I'm saying? So I put on these trades. Volatility was a little bit heightened, and each one, I just go back and forth until each one, like I said, the more each day passes and the price of this symbol stays in between these numbers. So if it doesn't go below this, it doesn't go below this, and it doesn't go above this, the more money this trade potentially makes. I'm probably not going to hold them all till expiration. It depends on just how much money they're making. If there's a big move on the horizon, there could be a big Fed announcement or something coming up that could, anything can spook the market and cause that heightened fluctuation, or activity, volatility, whatever you want to call it. But at the end of the day, it's possible to just essentially going back and forth in between trades. One becomes profitable, to lock in those profits, put on something that's literally the exact opposite type of trade. So this is a bearish trade, bullish trade, bullish trade. I had already took one off. And yeah, and the reason I like futures more than anything is just because of the buying power reductions. It doesn't cost a whole lot of money to put some of these trades on. Granted, this is, the micro NASDAQ, but it doesn't change the fact that these are not these don't have high capital requirements to put these trades on. And with Tastyworks, you don't have any account minimum. So as long as you have enough money to put the trade on, so in other words, enough money to have the trade on, then it's okay for you to not have a huge account. I feel like the buying power reduction on some of these is only like $50. Now the max that you could lose is more than that, but the amount that you need to put the trade on, like the amount that you could potentially lose on some of them is maybe 100 something or $200 max. But the amount that you need to open the trade is not very high. But that's why it's important to manage your trades. These are futures trades anyway, so they're trading 24 hours. And it works out well for me because I work overnight anyway. But I think this video is long enough. I hope that made some sense. And also, because you can rinse and repeat all day, every day, even if you don't have $25,000 in your account, as you would need with stocks, you can essentially trade as many times as you want. Granted, you're going to incur some more commission costs, going in and out of trades like that. But it doesn't change the fact that there's no pattern day trading requirement when it comes to futures. And a lot of people don't realize that. A lot of people also don't realize that they frown upon margin accounts because they think that you're just borrowing money to trade, but that's not the case, especially not with options. You can't borrow money to trade options, so because you can't borrow money to trade options, you have to have the capital to be able to put these trades on, to put these types of strategies on. And these are pretty basic, but basically all I'm doing is legging into iron condors. That's all I do. I leg into iron condors. So I put on one trade. Eventually, if I'm right, I put on the opposite trade. So instead of just putting this all in one transaction, 1, 2, 3, 4, instead of just putting, because that's what an iron condor is, to put spread and a call spread. Instead of just putting on 4 position all at once, I just put on one side of it, and then I just go back and forth, back and forth, back and forth. Okay, hope that helps somebody. Hope that made sense. Thanks for watching. God bless.